Good day. Today in this video, we're going to look at the difference between an asset and a liability. We have to bear in mind that in this video, we're not looking at the advanced principles of accounting, which is your financial assets and financial liabilities in financial instruments. But what we're looking at just the basic accounting principles of an asset and a liability. Before we go to the definitions of an asset and liability, let's look at something else, which is a very good concept for accounting. And this is called an accounting equation. Accounting by itself revolves around an accounting equation. And if we understand accounting equation, we'll be able to understand the principles of accounting thereof. You'll see that on my slides on my left hand side, I have the debit side. And on my right hand side, I have the credit side. Now, the accounting equation says the assets, which is the items or everything that I control in the business, minus liabilities, which is everything that I owe to the third parties, is equals to my equity. Now, what you see here, what accounting equation says, it tells you that now the more assets you have than your liabilities, then your business is well off. If you have more assets than the liabilities that you have, then you have what we call more reserves, of which you will be generating shareholders' value. But if you have more liabilities than the assets, then you're running a risk of liquidation, a risk of being insolvent, and all the likes. However, let's get back to our subject matter that we're focusing on today. You see that on my left-hand side, which is my debit side, I have assets. That means that all the assets that I have in my financial statements will have a debit balance. And on my credit side, I have liabilities, which is on my right hand side. That means that all the liabilities that I have will have a credit balance, which will be on the right hand side. Now, because the assets are on the debit side, on the left hand side, it means that every asset that you buy, which is an addition to the asset that you have, it will therefore increase on the debit side. And if these assets are decreasing, they will therefore decrease on the credit side. The same applies to the liabilities, but vice versa. Because the liabilities are on my right hand side, it means that if there is an increase in these liabilities, they will increase on the credit side, which is the right hand side, and they will decrease on the debit side, which is the left hand side. Now let's look at the definition of an asset. What is an asset? So an item that the business has control over the inflow of its future economic benefits. So in a nutshell, if I have something that I am controlling right now and I utilize that something so that I can be able to get future economic benefits in the future in the form of revenue, then that particular item is an asset. Asset can be in a form of machinery. If I'm using this machinery so that I can be able to generate future economic benefits, with revenue and all that, then I am having this machinery as an asset. Then it should be recognized as an asset. It should have a debit balance, which is on the left hand side. You can name a whole lot of assets here. You have machinery, equipment, bank itself, and so on and so forth. We said in the previous slide that the asset will increase on the debit side, which is on my left hand side, and it will decrease on the credit side, which is on my right hand side. Check my other videos where I explain how does an asset decrease, what leads to an asset to decrease. Now let's look at the definition of a liability. What is a liability? A present obligation resulting in an outflow of future economic benefits. In a nutshell, what we're saying that for you to have a liability, you need to have a present obligation. And that present obligation has to be in the form of a legal obligation or a constructive obligation. But in this session, we're only looking at the legal obligation side, because a constructive obligation can lead to a provision and all that, which is a liability, of course. But in this regard, we're looking at the legal obligation to say, if you go and borrow money from the bank, then the bank will make you sign papers which uh, actually give rise to the legal obligation. And then in that regard, then you have a liability, because you have to pay back that particular uh, money to the bank. In that regard, what we said in previous slides, we said the liability increases on the credit side and it will decrease on the debit side. Now let's look at an example, a very basic example. The company A gets a loan of 50,000. What we need to ask ourselves here is two questions. The first question you need to ask yourself is, do we have an obligation? The second question you need to ask yourself is, are we controlling something which will result in future economic benefits? Let's first start with this first question. Do we have an obligation? Well, company A went to the bank and did got a loan of 50,000. As a result, the bank will sign a loan agreement, and that loan agreement give rise to a legal obligation, and that legal obligation is a present obligation. Because we have a present obligation, it means that we need to pay out money in the future. In that regard, it means that we have a liability. We're going to do, we'll have the loan as a liability, because if this is an additional loan to the loans that we have, then it will have increased the liabilities that we have. Then it will have a credit entry, which is on the credit side, 50,000. Let's go to the second question. The second question, am I controlling something that will give rise to future economic benefits? Well, after you've signed all the papers in the bank paid you the money, and the money went into the bank account of this company A. Because the money is in the bank account of company A, it means that now you can be able to utilize that money as company A so that you can generate future economic benefits. As a result, it means that the money that you have in the bank, it is an asset. Therefore, we're going to say the asset, which is the cash in the bank, will increase. As a result, it will increase on the debit side. It's 50,000. Now here we see the magic of accounting, which is contra entry accounting, that says whatever happens on the right hand side has to happen on the left hand side, and whatever happens on the left hand side has to happen on the right hand side also. So this balances out, because you have 50,000 as a loan in liabilities, and also you have another 50,000 as an asset in the asset side as cash in the bank. Now, in summary, you need to ask yourself two questions. The first question, do I have an obligation to pay something back? If I do have this obligation, chances are it is a liability. Second question you need to ask yourself, do I have access to future economic benefits? Or rather, do I control something that will give me access to future economic benefits? If you do, chances are you have an asset. Thank you very much for watching this video. If you have liked this video, please subscribe to my channel, and also check the other videos where I'll be posting on other subject matters with regard to finance, business, and strategy. Thank you.